Hello and welcome to this video on basic accounting, debit and credit exercises part 2 in Dynamics NAV. So in order to understand this video, you must have seen and understand fully part 1 of these two videos. And at the end of this video you will understand how to perform these 11 fundamental transactions. So we're going to see how we book into the GL if we loan some money from the bank. And then we're going to be looking at some credit transactions. In the first part of this, or in the first video, we were looking at cash transactions. But in this video, we'll be looking at credit transactions. So these three first ones here are credit transactions without VAT. And credit transactions means that if you buy something, you're going to owe the money to your vendor, maybe for a month or two. And if you sell something, your customer is going to owe those money to you, maybe for a month or two. So we're not buying or selling in cash. And the next three transactions are going to be identical to the first three here, with the exception that this is going to be with VAT. So they are going to be, although they sound the same, they are going to be different from an accounting point of view, because we also have to book the VAT. And then I'm going to go through four other standard transactions. And as I said in the first video, when you've seen these two videos, you should be able to understand about 90% of all the financial and accounting transactions that takes place in NAV. So the next round of transactions will be the ones over here in the blue area, as opposed to the ones in the green. We now sell and purchase on credit. So that means that when we make a sale, we don't get our money instantly, and when we make a purchase, we don't have to pay instantly. It will typically take a month or so before we receive our money or before we actually pay our money. And this has some different implications to the way we book it into our accounts. So the first transaction here is to borrow $1,000 from the bank. And this transaction looks a lot like the equity we had previously over here. When we borrow $1,000 from our bank, our own bank account increases by 1,000. So we'll put in 1,000 here, because our bank deposits the loan on our bank account. So our bank account increases. But we also have to counterbalance this, or counterbook this with another credit of 1,000. So this is a debit of 1,000. And we have to do this down in the liabilities. The place to do this is on the loan account down here. So what this really means now is that 1,000 of those assets we have in the company are actually owned by the bank. So we now have 2,500 on the bank account over here. But of those 2,500, the bank actually owns 1,000 of those. And the remaining is owned by the equity or by the shareholders. So the next transaction here, we're going to buy a pizza. We're going to eat it right away, so instant consumption, and it doesn't have any VAT, and the cost is going to be $50. It's a rather expensive pizza, I know, but nonetheless it costs $50. So when we go and buy a pizza, keep in mind now that we are in the area of purchase and sale in credit. So when we go and buy this pizza, the pizza guy tells us that we do not have to pay him right away. In fact, he doesn't expect the payment until, let's say, 1 month later. So what we can say is that instead of paying him from the bank account, if we did pay him from the bank account, our bank account would decrease by 50. Instead, we put down we put it down in our payables here, and this is going to signify that we owe the pizza guy $50. So we're going to put a credit here. If we had taken it from the bank account, we would have booked credit or minus 50 to the bank. But in this case, we are putting it here, and later on we can move that to the bank account. But that will come in a later transaction. So we owe the pizza guy 50, and this has to be balanced off by a reduction in the value of the company, or actually the value that the shareholders have. And when we do that, it's down in the profit and loss area here. To be more precise, we're going to put it as a cost in the expenses. So we will debit a 50 here. Once again, debiting in the chart of accounts, you always see expenses as debit, and that's why it's a plus. Keep in mind that the sale would go in credit, which is a minus. So another way of looking at these $50 here that we owe the pizza guy is that the pizza guy owns $50 worth of the company. To be more specifically, he actually owns 50 of those dollars that are on the bank account legally. So the next transaction here is where we buy an iPad for resale. There's not going to be any VAT, and it will cost us $300. So if we were to buy it by cash, which we are not because we're buying it on credit, but when we bought it by cash, we would take the money from our bank account. But we are not taking any money from our bank account in this transaction. Instead, we indicate that we owe this our iPad vendor, we owe him $300, or the company owes him $300. So to balance this out, we need to not put it as an expense because we're not consuming it. It still has a value to the company. So we'll have to put it on the inventory account up here. So what this transaction says that now our iPad vendor actually owns some of the company. More specifically, he owns $300 worth of assets in the company. And he's going to get those $300 in a month or so from our bank up here. So in this next transaction, we're going to sell the iPad that we just bought over here. But we're going to sell it on credit, which means that we do not expect our customer to pay us the money right away. So when we did sell it for cash over here, we would see that the money would go into our bank account, $600 worth, and they would have been booked here, but we don't see the money right away. So instead we make a note that our customer owes us $600 here. It's almost as good as money in the bank, but not quite as good. So plus 600 here, or debit 600 here. This is counterbalanced by an entry in the sale, because the profit and loss being a sub-account to the equity. When we have made this sale, or our assets have increased by 600, it's our shareholders that actually earn those money, and we are going to put all transaction on shareholders down in our profit and loss. So we'll have to record minus 600 here. And once again, minus is credit and sale is always credit. So this is a good thing for the company. But this is the upside part of selling. The downside part of selling is that something disappears from our inventory. More specifically, the iPad disappears from our inventory. So our inventory account has to be reduced by a credit of 300. And this is a bad thing for our equity or shareholders. So we have to book this down in our profit and loss, and we have to book this, or we will book this in our account here called cost of goods sold. So we have an upside, which is the 600. We have a downside, which is the 300. But all in all, this is a positive thing for our company because we have just realized 300 worth of income. We still haven't received the money, but this is good enough for registering this as a profit. Getting the actual money is something we can be bothered with later. But the customer has committed now to pay us the 600. So in this next transaction, we're going to buy another pizza and we're going to eat it right away, instant consumption, so that once it's bought, it doesn't have a value for our company. It is with VAT, so the pizza guy expects us to not only pay for the pizza, but also pay some VAT to him, which he will eventually pass on to the tax authorities. And the cost of the pizza before VAT is 50. So we have to pay him $60 in total for this pizza. When we did that over here, paying with cash, we would book this into the bank account. But in this case, the pizza guy says, you don't have to pay me right now. You can just pay me in a month or whenever you feel like it. So we actually don't have a reduction in our bank account, but we have to record this as we owe this money to the pizza guy. So once again, this goes to our payables or our creditors, and we have to pay him eventually $60 like this. So these $60, in order to balance those off, we'll have to put that as an expense. So the reduction in assets, or it is in the liabilities, but the reduction in the value of the company because of buying this pizza has to be balanced on the equity account here, but we do that down in the profit and loss. So it will carry an expense of $50, and it will be debit because expenses down here are always debit. So, but we still need 10 to balance this transaction, and those 10 are in the, where do we have it? In our purchase VAT up here. So in order to balance this out, we have to put another 10 here. And this means that we should expect that we can reclaim or get back $10 from the tax authorities. In fact, those $10 that we will later pay to the pizza guy. So in this next transaction, we are buying an iPad and we intend to sell it, so it's not consumed. We can put it on inventory when we buy it. It's going to be with VAT, so our iPad vendor is expecting us to pay him some VAT on top of the cost of $300. So when we go down and buy this iPad, he will tell us that we don't have to pay right away because we are buying on credit. So instead of reducing our bank account with 300 plus 20% tax, which is 360, we will note this as a payable here, or on our creditors account. So we know that eventually we will have to pay our iPad vendor 360. These 360 are, when we receive this iPad, we get to put it on inventory because it still has a value to our company. So our inventory will increase by 300, but it still doesn't balance. So the remaining $60 will have to go to our purchase VAT here. So we'll put that in here. And what this means is that although we eventually need to pay our iPad vendor 360, we can actually get 60 of those back from the tax authorities, and the remaining 300 is still stuck in inventory or sitting in inventory. So this doesn't really have any negative impact to our company, nor does it really have any positive. It's just a rearrangement of our assets or the values in the company. So in this next transaction, we are going to sell the iPad with VAT for 600. But this time we're not going to expect the customer to pay us right away. In fact, we tell him that we are happy with receiving the money further down the road, maybe in a month or so. So we sell him this iPad and deliver the iPad to him. And this means that the customer now commits to paying us for the iPad, but also for the VAT that we have to pay to the tax authorities. So 20% of 600 is 120. So we have to charge him a total of 720, which we will book here in our assets. So the value of our company has just risen, which is a really good thing for our shareholders or the owners of the company. But when this is good for them, we book it down in the profit and loss here, and we book this as a sale. So we are increasing our sale, which is a credit, and we do that by 600, like this. So to justify for the remaining 120, which are money we are going to receive 720, but only 600 of those are for us. So the remaining 120 we'll have to pay to the tax authorities, and that is a liability, and we'll have to book that in here. So eventually we'll have to pay the tax authorities $120 later on. So, but this is the upside part of the sales transaction. So something also happens when we sell something from our inventory, which is the downside part of this transaction, and that is that our inventory is going to decrease. It's decreasing by 300, which is a bad thing isolated. Looking at it isolated, this is a bad thing for the owners of the company. So, but instead of booking it to the equity account here, we'll book it down in the profit and loss as a cost of goods sold. So these two, looking at these two isolated, is a bad thing for the company, and it decreases the value to the shareholders. But the good thing also happens in this transaction, which increases the value to the shareholders. So the total outcome of this transaction is very positive. In fact, we have made $300, which can be read from taking the sales and subtracting the cost here. So next we can try to have a look at the balance now. What do these figures tell us right now? Well, if we start at the top here with the bank account, we can see that since our last period, it hasn't really changed. Well, it has changed because we lent or we borrowed some money in the bank, but actually we haven't received any money all the way for all these transactions. So this is only because we borrowed some money. So all the good things that happened in the period hasn't actually been paid to us yet. So the next thing we can see here is that we are owed, or the tax authorities owe us a total of $140. Unfortunately, if we go down a little further here, we can see that we owe the tax authorities $240. So totalizing, or the net of these two, is that we have to pay the tax authorities the difference between these two amounts. So if we look at this one here, 1,320, our receivables, this means that we should expect our customers to pay us $1,320. And when that happens in a little while, we get the privilege of booking this into the bank account, which is always a nice thing to happen. The next thing here on the next account is the equity of our shareholders. it's not really the true value of the equity of the shareholders, because we also have to take into consideration these sub accounts to the equity, which is the profit and loss. So if we look at the profit and loss, we have made a total of 1,000 actually, and although it says minus, it is a profit because it's a credit of 1,000. But actually some of that money was made in the previous period, and we have doubled what we made, which was 500. We have doubled that in this period, so we have made a total of 1,000, which actually has to be added to the equity up here. So the next 1,000 here is that it signifies that or the company owes the bank for a loan, or in other words, the bank that has given us this loan owns $1,000 worth of our assets. So if we were to break up or dissolve the company, the bank would need $1,000. Finally, we have our payables, and this indicates how much money we have to pay our vendors eventually. So if we summarize our total assets up here, we'll get to a total of 4,010. And if we summarize our liabilities here, we'll get to a total of 3,010. And the difference between those two, because we would expect it to balance, is the profit we have in our profit and loss, which is a credit of 1,000. So the next thing that happens here is that we're going to pay our vendor, and we can see that we owe him or them a total of $770. So we're going to put this to 770 like that, and this means that our bank account will be reduced because we are actually paying the vendor. So the bank account goes down by 770, and you could say that although this is not a good thing for our bank account, the good thing, so this is like the bad thing of this transaction, but the good thing is that we no longer owe our vendors any money. So the next transaction here is to receive money from our customers. And if we go out to our receivables account here, we can see that our customers owe us $1,320. So on this day, they have decided to pay us those money. So we will see an increase in our bank account of $1,320. So that's a good part. That's a good part of this transaction. The bad part of this transaction is that we can no longer hunt them for owing us 320. So so they no longer owe us any money. So in the next transaction here, which is called move profit to equity, that is what NAV calls the close income statement. And what it does is that it cleans the profit and loss, and it moves everything up to the equity account. This is typically something you do at the end of the year. So in order to clear this account, we'll need to bring this account down to 0, which is done by 2,400, like this. So we now have 0 in sales. We also have to bring our cost down to 0, and this is done by minus 200. And we have to bring our last cost down here down to 0 as well. So the total of our profit, which is 1,000, needs to be booked to our equity. So this is really realizing that all the transaction we booked into our profit and loss was in fact a sub-account to our equity account up here. So to make this balance, we will put a credit of 1,000 here. Remember that when we put a credit of 1,000, it's actually this is a good thing viewed from the perspective of the equity or the shareholders. Isolated, this transaction doesn't make them any richer, because it was assumed all along that all the money which were on the profit and loss down here, in fact, were owned by the equity or by the shareholders. But this more explicitly tells us now that the shareholders own a value of $2,000 in the company, and it also prepares our profit and loss accounts for the next year, so that we can start fresh with zero all the way down here. So the final transaction that I've put in here is to buy an iPad the Navision way, because it's slightly different from when we looked at it over here, but we really had to go through these steps in order to understand this the way that Nav does it. So the scenario is really the same. We're buying an iPad, and it's for resale. It's with VAT, and it costs $300, like this. So when we buy an iPad the Navision way, Nav says that, well, first of all, we owe our vendor now 300 plus the VAT, which is 360. So that's the same as over here. So we'll put that in here. We owe our vendor 360. The next thing that Nav says is that, well, this is an expense. This cost us money. So Nav books this into what is called a purchase account, and these things are set up with posting groups. So Nav puts in a value of a cost of 300, and then Nav says that well, we still have to justify for the VAT, which is the purchase VAT. So we'll find that up here, and we need to book 60 on this purchase VAT here. So this actually makes it all balance. But then Nav says, well, this is not really an expense because it actually has a value to our company. So I'm going to move it to the inventory. So to clear it up or remove it from the profit and loss area here, Nav books to another account, which is called direct cost applied account. And it does this with 300 of credit. And those 300 of credit are balanced out with a value on the inventory account up here. So our inventory increases. So we actually end the same place as when we did it over here. We end with 300 on our inventory. We end with 60 on our purchase VAT account here. And we end with 360 on our payables. But we also get these two extra entries down here. And the reason that Nav does this is that you cannot always count on the what you pay for an item and which value it has to when you put it on the inventory, that is the same. If, for example, your costing method is standard cost, this will not be the same. So you could buy the item for some days you buy the item for 300, sometimes you buy it for 301, maybe 305, maybe sometimes just 295. But we have decided that whenever we book this into the inventory, it has to land on our inventory at a value of 300. So if you were to buy this item at different prices from time to time, it would always go in inventory to 300, but then the difference would be booked down here in our profit and loss as a variance, either a positive variance. If we buy it for let's say 305, you would see a negative variance booking down here in the profit and loss. But long story short, if you buy and sell FIFO items you will always book your item into the inventory at the same value that you bought it for. So you will just see these two entries down here, and they will always have the same value.